Tomorrow is the first day in a long time, at least that I can remember, we get major economic data and the markets are closed. With that said, Fed Waller may have just warned us about 12 hours ago what to expect tomorrow, and nobody paid attention. I mean nobody. You're probably going to be blindsided by what Fed Waller just said because nobody was talking about it today. If Jerome Powell said this, stocks would have probably been down 2 to 3% today. This comes at a time when CNBC just did a new survey polling hedge fund and institutional money managers, the guys that run the whole fund, and about 61% of those money managers believe stocks are likely to pull back from here. So here in this video, we will be going over your data coming out tomorrow, some troubling things JP Morgan just said, quote, stocks could crash unexpectedly for really no reason, and the crash could actually be a crash, like a 20% pullback. Just for context, this would take you back to the October-November lows of 2023. During this period of time from July through that correction event, you actually fell about 10.5%. So could the markets fall 20% from here? What are my expectations? What do I think is going to happen? And did Fed Waller just give us a warning? Hit the like button and subscribe to the channel if you have not done so already. It's free 99. And let's get started with this warning from Fed Waller. It's a video clip about 2 minutes long, so I will play that and tell you what I thought was notable.
In my view, it is appropriate to reduce the overall number of rate cuts or push them further into the future in response to the recent data. This just reflects the reality of managing an outlook in real time as data comes in. Now, subsequent data may well alter this outlook again, but we shall see. Based on what we know now, there is no urgency in taking that step. So where do I see things standing? I see economic output and the labor market showing continued strength, while progress in reducing inflation has slowed. Because of these signs, I see no rush in taking the step of beginning to ease monetary policy. The target range for the federal funds rate has been 5.25% to 5.5% since last July. And I believe that this restrictive level is helping to reduce imbalances in the economy and continuing to put downward pressure on inflation. All indications are that the economy continues to grow at a healthy pace. While retail sales and some other indicators suggest a softening in demand this quarter from the second half of last year when growth accelerated, the evidence for a significant slowdown is sparse. Meanwhile, as the labor market continues to add jobs at a rapid pace, some signs point to improvement in the imbalance between supply and demand, but others indicate continued tightness. My judgment on the balance of risk for monetary policy, which I explained in a speech on February 22nd, hasn't changed. The risk of waiting a little longer to cut rates is significantly lower than acting too soon. Cutting the policy rate too soon and risking a sustained rebound in inflation is something I definitely want to avoid. As a result, in the absence of an unexpected and material deterioration in the real economy, I'm going to need to see at least a couple of months of better inflation data before I have enough confidence that beginning to cut rates will keep the economy on a path to 2% inflation. Fortunately, we can wait and see how the data come in before deciding the appropriate time to start lowering the policy rate. The remarkable U.S. economy keeps on chugging along, adding jobs at a rate that over time will keep unemployment near its current historically low rate. But the overall strength of the U.S. economy makes it a fairly easy decision to wait a little longer to get a better understanding of the trajectory of inflation and, when appropriate, to begin easing policy.
So The thing that really stuck out to me is Fed Waller is literally reading off of a paper. A lot of the time, if you watch these Fed events, not everywhere streams them. Some are not streamed live for people, but most of the time, Fed officials do not read off of a paper, like literally reading a script. Most of the time, they're asked questions and they conversate, and it's not this precise. Now, the language that Waller used was very assertive towards the direction of, we're going to wait on cuts. That's really what I got out of this. But I guess over the past couple of years, a lot of people have noticed, including myself, that before we get a quote unquote like rug pull or rug tug from Jerome Powell, we hear different Fed officials basically warning you, like, hey, we're not going to be cutting rates. And it's almost like a warning that Powell is going to shock the markets to some degree. What's interesting is tomorrow we hear from Fed Jerome Powell, markets are closed, and really, I think the markets might be surprised. Let's be honest, the summary of economic projections that we got on March 20th was very bearish. It was not good. What did markets do? Well, the markets rallied. Most importantly, the reason why that happened is not because everyone's, super bullish on the dot plot or what the Fed actually said necessarily, but because the dot plot still showed 3 rate cuts in 2024. At the same time, the Fed lowered the amount of cuts for 2025, lowered the amount of cuts for 2026. They raised the long-term neutral rate, which I was surprised markets didn't sell off on that, and we kind of just continued to go higher. But it's this column right here on the right side. It's the range here. So this is showing you the most dovish Fed official and the most hawkish Fed official, what their expectations are for Fed funds rates in 2024, 2025, and 2026. So back on the December summary of economic projections, after we had seen a lot of progress on inflation, the most dovish Fed official believed Fed funds rates by the end of 2024 would be 3.9%. To the contrary, the most hawkish Fed official expected Fed funds rates to stay unchanged throughout 2024. So no cut, no hike, just a continued pause throughout the entire year. In this latest summary of economic projections, guess what the most dovish Fed officials guess for the Fed funds rate is by the end of 2024? 4.4%. That means there was a 50 basis point jump. Two rate cuts got priced out by the most dovish Fed official, let alone kind of a medium, kind of dove, kind of hawk, right? A medium. The most dovish Fed officials' estimates went up by two cuts, essentially. That's a lot. And I mean, look at this for a little bit of perspective, right? The most dovish Fed official is at 4.4%. The projection by the Fed by the end of 2024 is 4.6%. I will tell you right now, most Fed officials do not believe we're getting 3 rate cuts in 2024. Most Fed officials are thinking along the same lines as Fed Waller. 1, maybe 2 cuts if you're lucky. But what happened during the summary of economic projections and the press conference, Wall Street, the algorithms just looked at 4.6%. They didn't care about anything else. And algorithmic trading programs, quant funds, they make up about 80 to 85% of the trading volume each and every single day. So the algorithms are really the ones that bought stocks on this dot plot. And none of the dot plot was good besides the 3 rate cuts that were priced in, and that barely happened. If 1 or 2 Fed officials were to have raised their estimates just 1 cut higher, the average would have came in higher than 4.6%. And again, just to put that into perspective, the most dovish Fed official is at 4.4%. The most hawkish is at 5.4%. If the most dovish is at 4.4%, the median is likely around 5%. I would say that's the average out there from Fed officials, maybe even, a little bit higher than that, maybe a little bit higher than 5%. So this did catch me by surprise when you still priced in 3 rate cuts. And keep in mind, it's not like the Fed gets together and they're like, hey, we're going to tell the markets we're going to price in 3 rate cuts. No, they put their dots on the little dot plot, and then you get these aggregate numbers based on the average. If none of that made any sense and it sounds like I'm speaking a foreign language, really what you need to know is the dot plot was actually pretty bearish if you look at anything else besides the 4.6% projected federal funds rate by the end of this year. And really, the average Fed official is likely nowhere even close to 4.6% as their baseline estimate right now for Fed funds rates by the end of this year. So why is this a problem heading into tomorrow? Well, to some degree, it looks like Fed Waller tried to brace the markets for what could come next. And if you remember, Jerome Powell was very dovish, was very bullish sounding on the last press conference. Maybe he changes that up coming tomorrow. And again, keep in mind, markets are not open, so I don't know what kind of effect this could have coming on Monday. Maybe it's bad and people just stew on it all weekend and Monday's really bad. Maybe it's bad. Maybe the data comes in bad, but that time over the weekend, let markets digest it, and maybe you don't have such a bad Monday. I don't know. If there was any chance or moment for Powell to be bearish, it is on a Friday where the markets are closed. So you have the whole weekend to process the information. Kind of like a trading halt in a stock, right? If a stock just starts collapsing and the volatility, I believe it's like 2 standard deviation move in 2 minutes or 3 minutes, something along those lines, they halt the stock for like 15 minutes. That's because when markets are open, when you get news, markets can panic. And then you give people a period of time to kind of digest and figure out what this news means. Most of the time when that stock opens from a halt, it rises. Think about this like a longer term just halt if we get bad news. What does the open mean on Monday? I have no idea. But Powell does speak at 11:30 in the morning coming tomorrow. And again, if there was a time for Powell to be a little bit more hawkish, it would be tomorrow on a Friday when the markets are closed. So the way that you're set up here, it doesn't look great, especially what Waller said. Let me know what you think about Powell coming tomorrow. Beyond that, I'm not going to speculate too much because Powell could be, really bullish or really bearish. I honestly have no idea. And a lot of that may depend on the data that we get in the morning. 8:30 in the morning, Eastern Standard Time tomorrow, you're going to get core PC price index month over month. Trading Economics has the estimate at 0.3% month over month. What I've heard from Bloomberg and other, estimates out there, the actual estimate's like 0.4%. Trading Economics, their estimate is a little bit lower, but for the most part, you're expecting basically an unchanged core PCE month over month. If that happens, that's not terrible. It's not great, but it's not terrible. If you come in like 0.5% or higher, that's very problematic. Personal income month over month expected to come in at positive 0.4%. Honestly, that would be an annualized rate of about 4.8%. That would be great because if inflation is off to a high start right now, you don't want to see inflation gaining faster than wages. At the bare minimum, you want to see wages outpacing inflation from an economic standpoint because that means people are still going to have purchasing power and grow that purchasing power to spend out in the economy. Now, CPI is CPI. We all know prices have went up more than what the numbers suggest. So, did your 25, 50 cent raise really get you that much goods or that much more goods or services out there in the real economy? I don't know. I'm just giving you the perspective from the market's perspective. So personal income, really the higher, the better there, as long as it's not too high. Personal spending month over month, this is a big wild card for tomorrow. Last month you came in at 0.2%. Keep in mind this is month over month, and you're expecting 0.5% for February. If spending increases, if people are spending in the economy, that's 70 to 73% of GDP every single quarter. That's going to be great news. Keep in mind, good news is always good news for the markets, or good economic news is always good news for the markets. Even if you're in a market like 2022 or early parts of 2023, where bad news was seen as good news, no. Good economy is always good good news for the markets because that means companies are likely to come in with earnings estimates and maybe beat the earnings estimates. Economy starts to weaken from here. Personal spending comes in bad. You really want to be on lookout for a potential pullback in the markets, a correction event, because I mean, if the consumer gives out at some point in 2024, earnings estimates are way too high. And that could become the prevailing narrative on Wall Street. Again, if that becomes a topic of conversation, I'm sure the Fed's going to be cutting rates quite a bit more than we expect today. So I think in the near term, the Fed is probably the biggest catalyst, as well as PCE. But as we go throughout 2024, keep a close eye on the economy because like you've seen in 2022, if the economy gets bad, if recession fears come about, you could be looking at a 20+% pullback. And that's exactly what JP Morgan is actually expecting. They say the S&P 500 will plummet 20% and finish the year at 4,200, warns JP Morgan, which says stocks are currently so crowded that they may crack without warning. You're not going to get a 20% crack in the markets with no warning, with no news at this point. Okay, not with the Fed, how dovish they are, earnings estimates continuing to kind of stay where they are, if not incrementally go higher. Just for context, again, like I said in the beginning of this video, that would put you back almost to your October, November lows of 2023. That would be a huge fall. In retrospect, that would be like a huge crash, right? If that ends up happening, I'm going to be dead wrong here because I don't think that's going to happen. JP Morgan, they're always a little bit more conservative, but there's only a couple things that could cause a 20% crash from here, minus any black swan events we don't know of. Number one is Powell and the Fed putting the optionality of a rate hike back on the table. I think you need to see 2 or 3 more months of high inflation to actually get to that point, though. So I think you're quite a ways away from that, at least 3 to 4 months away from even having the possibility of the Fed saying, hey, we may have to raise rates again. That could definitely give you a 20% crash. The other way you get a 20% crash is if earnings estimates start to fall, if the consumer starts to do poorly. And really going hand in hand with that is the economy, right? If the economy starts to look weak, earnings estimates will start to go down. And that just makes stocks more expensive on a valuation basis. That's not a favorable market if earnings expectations are falling. But minus those two things, unless we have like a black swan event I cannot sit here and forecast, you're not getting a 20% pullback. But indeed, a majority of investors believe a stock market pullback is near, according to this latest CNBC survey. A majority of respondents, actually 61%, in the latest CNBC Delivering Alpha stock survey believe the broader market has run too far, too fast heading into the second quarter, and a pullback is near. So we're more than likely going to see a pullback in our markets, but probably like a 7 to 10% correction. You also need to keep in mind it is an election year, so there's going to be a lot of pressure on the Fed to start cutting rates if markets start to fall from here. And really think about this logically. In terms of the word correction itself, you're implying something needs to be fixed. Something got too stretched. It needs to kind of realign with where fundamentals are, where these stocks should be at. If you think about the broad markets, a lot of stocks have already went through corrections. Look at Tesla, down 28 to 30% to start the year. Look at small cap stocks broadly, a SoFi, a Fubo, I would say PayPal, but PayPal has been doing pretty well recently. Look at CRISPR, look at all of these small cap interest rate sensitive names. They have already repriced. They've already corrected to the downside. It's Nvidia, it's Microsoft, it's Facebook, it's these large cap companies that may be doing most of the correction if we do start to go into a correction. The last thing that I will say here on specifically a correction is actually portfolio rebalancing. So what happens at the end of a quarter, especially during a quarter where the S&P rallied like 9% in Q1, I believe in between 9 and 10%, the NASDAQ up a little bit more than that. That's a whole year's worth of gains. Typically, you're going to see a correction anyways, but you get something called portfolio rebalancing. Portfolio rebalancing is like, hey, in the disclosure for a fund, let's call it a, ARK Invest for that matter, or BlackRock, whatever it is. They may have a mandate. They need to be index weighted to the S&P. Fine. Okay, they choose their basket of S&P 500 stocks. They get market weighted to the S&P. Some of those firms are going to have mandates of you can't own position size relative to the portfolio of 3% or 5%. So if it goes higher than that, by the time statements are coming out at the end of the quarter, if let's say Nvidia, you bought Nvidia 3 months ago at 5% weighting of your portfolio, the stock, just call it doubled up. Now it's 10% of your portfolio. You got to start selling some Nvidia just to get back to your disclosure that you gave your investors. So big tech has run a lot. There was a lot of portfolio rebalancing. What happened the last couple of days? Your small cap interest rate sensitive stocks outperformed. Look at even today. The NASDAQ was down over 0.1%. The Russell was up 0.5%. So this is typically a pretty good sign that you're going to see some kind of downside, at least for your big tech names. Yeah, that was my 9-month-old son pulling the camera down because he loves pulling on cords. But with that said, just to kind of wrap this up here, if you've seen this kind of underperformance of big tech and the NASDAQ the last couple of days, with this portfolio rebalancing, it wouldn't surprise me if you do see a correction that is mostly, not all, but mostly focused in the NASDAQ, in the stocks that have underperformed the Russell over the past couple of days, most of which would likely be Nvidia, Microsoft, Facebook, so on and so forth. Let me know what you think about this information down below in the comment section. What is your expectation for Fed Jerome Powell tomorrow? Do you think he's going to say something that upsets the markets? And what about the data? Do you think a correction is overdue for our markets, or do you think stocks will continue higher from here? Thank you for watching. Enjoy the rest of your day. On your way out, hit the like button as well as subscribe to the channel. You guys enjoy your weekends, and I will see you in the next one.